with gold prices over 1400 in US dollars at 1423 and gold prices at 6-year highs, I thought it was smart to do another mining stock education lecture on understanding risk versus reward and how to do your research, how to update things, how to understand what's going on at a company and with its specific assets. Because right now with mining stocks, what is happening, they're becoming very popular, and the mining stocks that have the worst balance sheets and the highest costs, the more marginal producers with this big rise in gold price the last 4 to 6 weeks, have, when gold price went from, in the low to mid 1200s up to 1423, now it's almost a $200 rise. The more marginal gold miners with higher costs and bad balance sheets have gone up more on a percentage basis. But I want people to understand this is not if you're a short-term trader. If you're a short-term trader, congratulations on your profits. Again, this is not going to be financial advice. This is just my opinion, and this is a lecture for informational and educational purposes only. We're going to go over how to do research, and we're going to look at case studies of companies and mistakes that management teams have made in the past, and problems with specific mines and what has gone wrong in this lecture. So right now, like I said, many marginal miners are outperforming the more sound miners with better balance sheets and better projects. And that is because the metals price is rising. And if the metals price continues to go up in the near future, a rising tide will lift all boats. And so the worst miners with the worst fundamentals may actually outperform. The old saying is a rising tide lifts all boats, turkeys fly in the wind. So in a scenario where the gold price is going up, people are less likely to look at fundamentals, problems with management, problems with specific assets, etc. And as a investor in some of these mining stocks in the past, where I have made hundreds of % returns in 2 or 3 years and then cashed out, you have to understand and I'll walk you guys through later in this lecture, I will walk you through a trade, how I made hundreds of % return on my Lundin Mining copper trade. It was top down, bottom up, macroeconomic analysis, looking at the global macro picture and central banks, what China was doing, and then bottom up, looking at the individual company, their asset, management team, etc., and how I was able to buy shares in February 2009 around 39 cents American in February 2009, and around July of 2011, I sold my shares around, I only bought 500 shares though, so it was not a big trade, it was just a speculation, but I sold my shares at $5 each. So from 30-something cents per share to $5 per share in about 2 years. And I'll walk you guys through that now. I did the research later. So one of the things that I've noticed, and I've talked to a lot of my listeners over the years about gold and silver and mining stocks, and my expertise goes far beyond that. I'm a value investor. I look at companies. I understand economic moats with value investors and how to look through financial statements. But most of the people who invest in mining stocks, except for a very small percentage, where recently, and one of my podcast listeners brought up a very well-researched thesis for K92 Mining, and he knew the company forwards and backwards, and it was very impressive. But the majority of people that buy these mining stocks do not do that type of due diligence, unfortunately. And in order to get those types of really good returns, unless the gold and silver prices are going crazy, and then, like I said, the gold and silver prices are going to lift every company, unless the company is just egregiously managed, or management team overpays routinely for bad assets, so they do a really dumb acquisition, or management team screws up the balance sheet. Then in a rising gold and silver price environment where they keep rising, anyone can look smart. There's the old Wall Street saying, and it's in the Larry Livingston, well, it's the book about Jesse Livermore. I think it's the Speculator book. I forgot what it's called, the exact title. But it's Don't Mistake a Bull Market for Brains. And so if we do have a scenario where the gold price keeps rising and rising and rising in US dollars, you're going to have a lot of people acting like they're geniuses for picking out the most riskiest juniors and the gold and silver miners with the worst balance sheets, the worst assets, etc. But you have to look, if you want to be a really good investor or speculator for longer than a couple months and a technical chart trader, you have to understand the framework for risk and reward, okay? And this is not financial advice. This is just how to do research. This is case studies. And unfortunately, in the hedge fund community, a lot of people in hedge funds, they use the phrase asymmetry way too much, okay? An asymmetric trade, blah, blah, blah. It's bullshit, okay? It's way overused. The way you should think for any company in any industry is about risk versus reward. And with a mining company, if you do not understand the downside, if you do not understand all the risks of a mining company, and you're holding this thing for a long period of time, you could lose all of your money or almost all of your money within a year or two. Because management teams historically have that bad of a track record. Over $80 billion in bad deals has been done since 2010. $80 billion. And people are wondering why the gold mining industry doesn't have more love, doesn't have higher market caps. It's because the management teams, most of them, have been horrible. Horrible destroyers of capital. So let me talk about risk versus reward. And the way you should do this and to think about framework and research is it's probably, if you're going to do this the right way, the way I do it, I can do this in my head now because I've looked at so many mining companies and my memory's pretty good when I've eaten healthy and have supplements and had some caffeine, cup of coffee and some green tea. Later in the day, I feel really good and I can remember a lot of these things either off the top of my head. But if your memory is not good and you're looking at mining companies, you may want to start a Microsoft Word program or an Excel spreadsheet. And it's just really simple and no one does this. I'm sure some professional investors do it, but they don't go out there and give you the recipe for how to do it on your own. You need to create 2 columns, like a comparison column for a company, and you go and write reward for reasons the stock should go up, and then you go and write risks, downside problems with the company. So before I talk about rewards for the company, let me talk about risks for mining companies, and there's a lot of them. Okay, the first major risk for a mining company, given what I said with the deals that have been written off, is management teams. Historically, for the last 10 years or so, management teams have grossly overpaid themselves with salaries and shareholder options. They have misallocated massive amounts of capital on bad deals. Remember what I talked about with Hecla Mining. Hecla Mining grossly overpaid an enormous premium for Klondike's mines. Everyone was shaking their head why they did that deal because they paid a 65% premium, I believe, to market prices after those shares crashed for, I think, 2 mines that had enormous production problems that were going to cause a lot of capex problems, a lot of extra costs. So management team is very important for a mining company, whether it's a big mining company or a small mining company. And there's different sets of problems for a big mining company and a small mining company. A small mining company, if they, like K92 Mining, let's use an example. K92 Mining, which the listener told me his thesis for on the long side, sounds like a solid, this is not financial advice, but sounds like a solid risk-reward play. They already have the infrastructure for the mine. They have a senior management team from Barrick Gold that has built mines, and it looks like the project economics for the project, along with exploration upside, are good. So reward-wise, it looks on that side of the column, it looks like they have solid rewards. That the market could reward this miner with a much higher multiple. And when a miner goes from not producing gold to producing gold on time, on budget, profitably, with a good margin, the miner starts to trade, and this is reward-wise, at a higher multiple. Normally, the multiples in the mining industry are on operating cash flow or net asset value. Okay, so the multiple, if the miner can execute their business plan, so if they can build their mine on time, on budget, and generate a good margin with some free cash flow, and maybe scale up the mine and increase production, have some exploration upside. Normally what the miners do is they only get about 10 years, if it's a larger mine, maybe 20 or 30 years of resource initially. And then once the mine is generating operating cash flow, then the operating cash flow is used for exploration drilling. And the exploration drilling is where the rewards can be had, where the mine life can be extended from 10 years to 20 years, 30 years, maybe even better than that. Or the case of Fosterville, which was, I think, more lucky because this is very rare, where you have a situation where it was a very mediocre marginal gold mine that no one wanted, and all of a sudden they took their operating cash flow, they drilled some holes deeper, and they found super high grade, the world's best underground gold mine. So from a risk reward perspective, what most people who buy mining stocks do not do is they do not do enough research. They do not spend an hour or more. They normally don't have researched what are the rewards for the company, a higher multiple as the company goes into production, as the company increases production, and exploration upside, things like that, and they a better valuation. And then on the risk side, and I honestly think the risk side, understanding the risk for the company are more important. So with the K92 example, what the risks would be, and I brought these up to the listener who brought the long K92 mining thesis, was that the risks would be geopolitical risk because their mine is in Papua New Guinea. The other risks are operational risk because they're still building a mine out and they're probably trying to scale up production. And then also balance sheet risk because it is a mine and there could always be something that goes wrong. And does the company have a good enough balance sheet if there's production problems and do they have capital cash on the balance sheet to not go to the capital markets and have to dilute or take on more debt? So the average retail investor, and many people I've talked to over the years, unfortunately, who put money into mining stocks, don't even do the basics. They don't research the track record of management teams. They don't see if management teams have had a track record of successfully building mines. Has management successfully built certain types of mines? Has management successfully built open pit mines? Have they successfully built underground mines? Have they successfully built a mine that's doing both? Okay, do they do those things? Has management not wasted capital on bad acquisitions? Okay, because there's a lot of these gold miners that the management teams, and some of them are still there at these companies, some of these guys have been gotten rid of. But there are management teams like at Yamana Gold and others that have done a lot of bad acquisitions. Hecla Mining is another. And the management teams are still there. And they're tasked with trying to fix the company with production problems and overpaying for bad deals. So the average person doesn't do this with the management team. So if you invest in a junior producer and the company only has one mine, they basically have to bet the whole company on the one mine. And I've seen companies where on paper, with the feasibility study, first off, you get before you get to the bankable feasibility study, and that is the most accurate project economics, the bankable feasibility study, that could still be wrong. There could still be some error. But I've seen situations where prior economic studies to the feasibility study, the PEA or preliminary economic assessment, or PFS or pre-feasibility study, those are the two economic studies prior to the feasibility study. I have seen economic studies of PEA and PFS where these things are nowhere near the real cost. These things are almost basically frauds, or they're so wildly inaccurate they're more than 50% off and basically useless. So you have to be careful about that. But I have seen junior producers, and I'll name a couple of them because we're doing case studies here. I've seen companies like Allied Nevada in the past and Huldra Silver, which on paper had very good mines, very good projects. But the problem was the mines that these companies were trying to build were not on time and on budget. The metals prices were falling, and management team made mistakes, and it was a bad combo. And despite on paper these companies having good mines, they still went bankrupt. Although Allied Nevada is restructured, I believe Eric Sprott, one of my listeners, told me is back in on the restructuring. But if you were a shareholder of Allied Nevada, the past version, things look good until they didn't. So, there were clues, there were red flags to get out of the stock before it went to zero. And if you do your homework, if you keep a Excel spreadsheet or a Microsoft Word program with each company you're either researching or you own shares of, risk versus reward, and you update these things, and you could do this for companies in any industry. So whether the company has a sustainable moat, whether they have a really good product with intellectual property, I could go on and on about different companies in different industries and how those other companies can obtain a durable competitive advantage, how margins can be eroded, those types of things from competition, patents can expire, those types of things. But for this specific lecture is on mining stocks. So the average retail investor who puts serious money into these mining stocks, individual mining stocks, does not do the due diligence, the homework required to protect themselves, to understand the risks that they are getting themselves into. And things can go pretty bad pretty quickly. Let me use two companies that were once darlings of the gold mining industry. You have New Gold, which was very well respected until Rainy River. New Gold was doing a superb job. I remember in 2009, I believe, I bought shares of New Gold during the crisis when there was still blood on the streets. I think I got them at $2 a share, and I sold it as a speculation. I didn't buy a lot of shares, but I sold it for 10 in 2011. I cashed out. So I made five-fold returns on New Gold. However, New Gold, because they had multiple mines, because management team wanted to keep growing the business, okay, they had multiple production and gold mines. They kept trying to take on larger and larger mines at more and more risk. And this is a different set of risk than a smaller junior producer. The smaller junior producer has to bet the whole company on one mine. Now, these larger mid-tier and senior gold miners, they don't necessarily have to bet the whole company on one mine, but depending upon the size of deal they do, they could. And that's another danger. In order for these companies to grow, in order for management teams to try to get rich, the management teams are trying to sell growth, and that's where the danger gets created. So New Gold was a very well-respected mining company, very well-respected management team. I believe at one point Pierre Lassonde was even on the board, and he was on King World News and other places promoting the stock. And he was even talking about how good of an asset Rainy River was, and they had enormous production problems with Rainy River. Enormous. So New Gold didn't go bankrupt, but a lot of executives, management team in there, the CEO was replaced, the board, I believe multiple people on the board of directors were asked to leave, and the share prices crashed because they bought a mine and it had enormous production problems when they were developing it, and it was not on time, it was not on budget, and it was causing just enormous strains on the balance sheet. And management team, if they had maybe done a better job or avoided the asset entirely, maybe the stock would not have gone through that type of pain. The other more recent example is Goldcorp. So Goldcorp had, for many years, Goldcorp had a very well-respected reputation as a quality mine builder, as well-managed. Rob McEwan, I believe, was still on the board of directors. He built the company, him and Ian Telfair initially, and then Rob McEwan, I think, went to the board of directors for a long time. He eventually sold his shares and got out. But Goldcorp stock, and I have a price chart up before McEwan Mining bought them, and Goldcorp stock, let me pull it up real quick. Goldcorp stock got as high as like $55 a share, $55.31 a share in May 2011. And yes, the gold price went down, but Goldcorp was still well respected for a number of years after the gold price was going down. But they just had tremendous problems bringing on this massive gold and silver mine, I believe in Mexico, called Penasquito. And so it hurt their balance sheet. They weren't hitting their revenues numbers and their earnings numbers. Their dividend, I believe, had to be cut. And so this pissed off shareholders. These are the downside problems I was talking about. So Goldcorp, eventually the shares got to around $11 per share after hitting a high of 55 in 2011. And the chart, the old Goldcorp chart, which is GG, Gary, if you want to look up the old chart, I'll attach a link. I think it's on barchart.com, the old chart. And the old chart of Goldcorp from 2011 to when McEwan Mining bought them and bought the assets for pennies on the dollar was real bad. Okay, in a couple years from now, if Goldcorp wasn't bought, they might have been in trouble. Although now that gold price is rallying, Goldcorp might have survived. But it was tough to predict. The other thing about the management teams, and this is true of any commodity industry, is management teams are almost always wrong about predicting commodity prices. So management teams tend to, at the bottom of the market, when management teams should be contrarian and have cleaner balance sheets with less debt, The management teams don't do that. They don't make smart acquisitions buying assets for pennies on the dollar when there's blood in the streets. Most management teams do not do that. When the commodity price is high, when the share price is high, that's when management teams tend to do dumb acquisitions. That's the resource industry, at least. Other industries, I'm not as familiar with about the history of acquisitions, but generally speaking, a lot of leverage buyouts with more and more debt don't work out. There's a lot of recent leverage buyouts that, with billions of dollars in junk bonds, that are going to fail. So I'm not going to answer any specific questions about mining stocks. I'm going to stick to the case studies. But the way to do risk versus reward is, on the reward side, you look at exploration upside. Is it a large land package? Do they have good geologists on staff? Are they going to have enough operating cash flow once the mine does the mine already have enough operating cash flow for them to reinvest, plow some of that cash flow back into drilling and go and look for more resource? So case study with Lundin Gold right now. Lundin Gold has not drilled off a lot of their Fruta del Norte property yet. They will, and they have a very large land package, and they will probably, this is not financial advice, probably find a lot more gold. It is a very large land package, very high-grade gold. It's one of the best margin high-grade gold deposits found in the last few years. Sandstorm Gold has a royalty on it. Sandstorm Gold does not have to spend any more money getting any of the extra exploration upside. Another company, another example, is Endeavour Mining. Endeavour Mining is a gold producer, a very solid mid-tier gold producer in Africa. They have a diversified portfolio of producing gold mines throughout Africa. And recently, the press release came out yesterday. Endeavour Mining announced that they used, with their operating cash flow, they increased reserves at their Huldra mine, which Sandstorm Gold also owns a royalty on, by 41%. And the Carry Pump high-grade discovery adds an extra 710,000 ounces of gold at a much higher grade. I think 53% higher grade than, 53% higher grade. So that will, if you're an Endeavour Mining shareholder, that exploration discovery will benefit you. If you're a Sandstorm Gold shareholder, that exploration upside will benefit you too. The difference is the Sandstorm Gold shareholder didn't take the risks that the Endeavour Mining shareholder did. And this is why with the royalty and streaming companies, they don't have, on the downside risks, they don't have as many downside risks of one mine that the management team gambled on to try to build on time and on budget, bankrupting the company. So the business model is just more efficient and better as long as the royalty and streaming company can get to a certain level, Sandstorm Gold level or larger, of diversified cash flow. And then they really start benefiting from that exploration upside with the partners. And I think Sandstorm Gold has the two senior geologists, two of the better ones in the industry from what I've talked to with people. They've had a lot of exploration upside success. And I think Sandstorm Gold's royalty on Carry Pump, I think that covers about 80% of the land. Doesn't cover 100%, but it covers about 80% of that land package that just discovered an enormous amount more gold. So let me talk about some more case studies now. I talked about Huldra Silver and Ally Nevada, and there were tons of very smart gold stock mining newsletter writers who were recommending those shares and did not warn their readers about the downside. I know them. I won't call them out specifically. I know they are. I'm friends with them. I don't want to call them out specifically. If you're a subscriber to newsletters, you know who they are. Okay, the project economics for both mines were sound, but the mines for each company ran into enormous production problems, and they were not on time and on budget. The metals prices were falling. Management team couldn't fix the balance sheet, and the company went bankrupt. The management team could not get the mine generating positive cash flow to be economic. So there's so many risks. So the newsletter writers did a disservice to their clients, not highlighting any of the downside risks. So people are like, oh, Jason, you're too negative on gold stocks. Well, you can make a lot of money on gold stocks, but most people who put money into gold stocks who are not short-term traders and don't have trailing stops or stop losses or buy gold mining ETFs, they do not, I will repeat this, the majority of people I have spoken to about gold stocks do not understand the downside risks. They cannot name that. I asked them about management team, they don't know. I asked them about the mine and project economics, and if the mine that's being built or ramping up to economic production is on time and on budget, they don't know. So if you're going to put serious amounts of money again, not financial advice, into any of these gold miners, you have to, I personally think you have to know these things. And you know what? You basically, if you keep a Excel spreadsheet and a Microsoft Word document updating risk versus reward of any risks of the company and rewards of the company, you're probably going to have to keep these things updated. I do it in my head. I do have some notes on some programs typed in, but I have them mostly in my head because I don't have enormous diversification. My money's where my mouth is. You guys know what's my favorite gold stock. I do own some other gold stocks like Wheaton Precious Metals, and I have a speculative position in Alexco. Again, not financial advice, just disclosure. I also have money in Sprott Inc. that pays a dividend. And Sprott Inc. has a team of geologists, and Sprott Inc. makes investments into junior miners. So Sprott Inc. has been paying me dividends for years, while their geologists on staff pick out the juniors for me. Okay, so let me talk about political risk. So on paper, when the silver price was still doing well prior to 2011, 2009, 10, and 11, when silver was starting to rip, after the central banks intervened, there was a junior miner named Bear Creek Minerals. They had a couple pretty good mines. They had the Santa Ana silver mine in Peru, and then they had this really massive silver and base metal mine called Corani. I think it was also in Peru, but in a different part of Peru. And their business plan was sound, that they were going to bring online this silver mine to go into production, use the cash flow of 5 million ounces per year of the silver mine, Santa Ana, to fund some of the costs to build Corani, which is a massive deposit. And unfortunately, the government in Peru, there was stuff with native protesters and others. There's he said, she said stories. I've heard different stories from people in the mining industry, management teams, and I've heard different stories from Peru residents about this. But the bottom line is the mining company didn't get their permits. Their permits to mine were removed for Santa Ana, and the mining company basically, I don't think it went bankrupt, but it went from quite a few dollars per share down to a tiny little penny stock because there was no immediate cash flow. There was going to have to be enormous dilution to build both mines, and this is geopolitical risk. So do you understand, if you're buying an individual mining company, and whether it's a junior miner about to build a mine or even a producing miner that has built the mine and is generating cash flow, hopefully free cash flow, do you understand the political risk? The latest political risk, and there's tons of them. I could spend hours talking about all the different ones, but the latest one is in Australia, in Victoria, the Victorian government on Fosterville. Now, they're not killing the project economics for Fosterville, but it's a 2.75% royalty. It's an extra $25 to $30 million per year. What happens if gold goes higher and the Victorian government all of a sudden decides that that's not enough royalty? So we're in an environment, unfortunately, where the politicians in any government can change the rules. In any company, in any industry. So if you're not paying attention, all of a sudden, the stock price, this is hypothetical, all of a sudden the stock price for Kirkland Lake Gold, KL, Kathy Lee, could be going up a lot, and then the Australian government issues a press release saying, oh, we're announcing from 2.75%, hypothetically, a royalty tax now, plus all the taxes that Kirkland Lake Gold is paying already on Fosterville, so an additional 2.75% tax. They could all of a sudden in the future, if gold goes to, say, well, in Australian dollars, gold's already a lot higher. But let's say it goes even higher. All of a sudden, they could issue a new tax that hurts the economics of the mine even further. And normally, this is more occurring in developing countries. So third world countries, developing markets, emerging markets. You normally see this behavior in places like Mexico, in places like Argentina, or Brazil, or in Africa. Normally you see behavior like this there. So the average person that I speak to about mining stocks, and I ask them questions about management team, track record for management team of building mines, if they built certain types of mines, what's the geopolitical risk, do you know? The average retail investor has put serious money into mining stocks and can't answer any of these questions. And this is what frustrates me, and this is why I'm doing this little lecture and rant. Okay, I've talked about Goldcorp, talked about New Gold. So New Gold was management team errors and operational and production errors. And then they hurt their balance sheet really bad. I talked about K92 Mining. I'm just checking my notes here. That's why I'm going off the checklist. Okay, I didn't talk about McEwan Mining. So McEwan Mining, if you're not familiar with it, it's Rob McEwan's mining company. He's pieced together assets. He bought the Black Fox mining complex for way cheaper than it was worth. I think he paid like $10 million in cash for about $200 or $300 million worth of assets at the Black Fox mining complex because Primero was about to go bankrupt. So he bought assets. He bought fire sale assets for pennies on the dollar. That's a valuation check mark there. That's a smart management team that bought assets for pennies on the dollar. It looks like he didn't overpay for that. On top of that, Rob McEwan doesn't pay himself an enormous salary. His money is where his mouth is. He owns a good amount of shares in the company. Those are also good things. If management team has a large insider ownership in the company and they're not drastically overpaying themselves. The problems with McEwan Mining is that McEwan Mining is a higher cost gold producer, and they do have some production problems at Black Fox, which they are working on getting fixed soon, and they just brought online the Gold Bar mine. So over the next couple quarters, hopefully those issues are fixed, and with a higher gold price, you might see McEwan Mining start to maybe dilute shares. You could see that potentially. But if the gold price, the risks for McEwan Mining is because they're a higher cost producer and they have some production problems at their mines, and they just brought a new mine online, in addition to production problems at Black Fox, that if the gold price does not stay high or go higher and it actually starts to correct and fall, McEwan Mining could be in some trouble. Okay, so that would be how you basic for looking at the company. And then you look at the individual mines to see if the mines are on time and on budget, if they're having production problems at the mines, if there's a big CapEx bill coming at one of the mines. That would take a lot of extra research work. You could probably, if you want to, also email management. No guarantees. Management is, you can email investor relations. No guarantees that investor relations is fully honest. They may just omit information sometimes. That's happened to me. I've had people forward me emails where the investor relations department of a junior miner was just blatantly lying. They were lying about one of their assets, a big land package, saying that this producing mine was running out of reserves when anyone could have checked at the producing mine that they had just extended the mine life by the producing mine next to the land package of the junior by a decade. So the junior was lying. I'm not answering any individual mining questions right now. This is a philosophical and research part. Philosophical and research lecture show. So people in general, rather than me giving you fish, I'm teaching you how to fish. The Lao Tzu quote. It's more important. So for the future, if you want to be the type of investor or speculator over a 12-month, 18-month, 2-year, 3-year period that can generate hundreds of % returns, you need to do at least an hour of extensive research work on a company before you would even consider putting any money in. That's an individual mining stock. With a mining stock ETF, you really don't have to do that type of research work because you have a basket of these things. Or with there's a number of gold mining mutual funds with the Tocqueville Fund, and I think Sprott has some of those. So they would do the research for you, but then you're paying a fee. You're paying a pretty large fee in some instances. So last thing here, before I let you guys go, I talked about everything I wanted to talk about except walking you through my Lundin Mining speculation. How I did the research and bought shares around 30 cents, under 40 cents was when I bought all my shares. And then within about 2 years, I sold them at $5 a share. Okay, so for me to do that research work, first thing I did was I was paying attention. I was reading all these value investing books with Warren Buffett and Benjamin Graham about buying when there was blood on the streets. And the copper price, I'd been paying attention to commodity prices, and I just read Jim Rogers' Hot Commodities book. And I was more bullish on China back then, but I saw the central banks were doing massive intervention with QE and bailouts and those things. And then I saw the China stimulus, right? And I saw that China was going to just go absolutely crazy with construction and building. They just tripled down, more than tripled down, I guess, from the construction and infrastructure building that they were already doing. They did just an insane amount of stimulus and QE. And they basically got a lot, besides the central banks inflating, a lot of it was China. The macro part, the top-down part. It was China doing the QE and the stimulus that got a lot of the global economy a little bit back from the abyss. And I knew that the copper price would rise. I think the copper price had dropped down to a little bit above $2 a pound. And I was like, China's planning all these insane spending purchases that the copper price is just going to go crazy. So then I started doing bottom-up research, which is individual specific company research. So I was like, I'm going to find a copper miner. I'm going to find a copper miner that got absolutely killed in this, that has a chance to grow revenues, grow earnings, maybe some free cash flow, and has a chance for a lot of upside. So I took a look at a lot of different copper miners, and you probably could have done well with a bunch of different copper miners back then. But the specific one I chose, because it had, I believe, crashed the most, was Lundin Mining. And Lundin Mining, if you're not familiar with their story, it's owned by a resource billionaire, a Canadian and I think Swedish billionaire. The Lundin family is very famous for resource investing, for oil discoveries, mine discoveries. They're world-class resource investors and speculators, and they have a long history of successful resource investments. They're not going to go bankrupt on any one thing, let's just say. They're always very smart about resources. So Lundin Mining had found, I believe they had bought this junior miner in the Democratic Republic of Congo. So there was just enormous political risk there, and that was also weighing on the stock. But apparently Lundin Mining had paid off enough bribes to get the mine permits and get the mine built. But one of the reasons that I thought some of the risk was offset was that Freeport-McMoRan was their partner, their joint venture or JV partner in building this massive copper mine in the Democratic Republic of Congo. I think it was called Tengu Fugurome. And if this mine was built successfully, on time and on budget, and this was a speculation for me, this was a speculation because of the political risk and the operational risk of bringing the mine on time and on budget, but it was just going to have enormous revenue increases, enormous profit increases, and Lundin Mining, I saw the big upside, the reward of going. So I was trying to weigh risk versus reward, political risk, enormous political risk in the Democratic Republic of Congo, and operational risk of trying to build a mine. The mine started being built during 2008 financial crisis because the copper price had crashed, and they were still building the mine because they wanted the cash flow. They weren't going to shut it down. And Freeport-McMoRan was also involved. So I thought, well, Lucas Lundin and his family, billionaires, that they probably won't let the company go bankrupt. And I didn't put a lot of money in. I only bought 500 shares at 30 cents, 40 cents each, something along those lines. I bought like 100 share tranches along the bottom. And I was like, they probably won't let the company go bankrupt. The mine does look like it's starting to make progress there, ramping up to economic production. They are moving things along nicely, unless the government seizes the mine, which was a risk. And then I saw the China stimulus. And I was like, wow, China is really going to force the copper price higher. They're just stockpiling copper. They're using it for all kinds of stuff. And I was right. It was some luck involved, but I did do a lot of research. And I tried to, with the research work and understanding the downside risks, as well as the rewards, at least some of the rewards, I tried to put the odds in my favor. Now, I didn't get the whole upside because I sold that at $5 per share and the stock is higher now, but the copper mining stocks are volatile, and I didn't really want to be long copper for a long period of time. I was only long copper for like 2 years. So that's how you do risk versus reward research for a speculation. So you look at the macro picture. What are these governments doing? What is central banks? What could potentially move a commodity price much higher, much lower? And then you go and look for individual specific companies that would benefit that. And does the company have the balance sheet to survive? Are they going to grow revenues? Are they going to be able to become profitable soon? Those types of things. And that's how I was able to speculate from 30 cents up to $5 a share. There was many times, though, before the share price took off, there was many, and let me look at the chart again. There was quite a while for Yes, it took like a number of months before the stock really did much. It was quite a few months. And I was really, really worried when I started buying. Because I think I was 24, 25 years old. It was a while ago. So, but I'd done the research and I hadn't put too much of my money in, and I thought it was a good speculation at the bottom. And the management team looked good. They had built mines before. The company was backed by a billionaire family. They probably weren't going to let it go bankrupt. But the other thing was the geopolitical risk. So that's why I didn't want to hold it long term, was because it was in the Democratic Republic of Congo. So once I had big gains, I just cashed out. So I think I covered pretty much everything that I wanted to cover. Okay. Oh, the other thing I wanted to point out is that if you do your research work and the valuation looks cheap and attractive, that it can change from a reward to a risk. So companies that are cheap and undervalued, and you get this right, like about Lundin Mining, and let's say it goes, you buy it as a speculation or even an investment from 30 cents, and it goes to $5, $7 a share, right? The valuation at 30 cents, that's a reward potentially with upside once they get that mine online and making money. And then once it's at $7, then there starts to be more risks. So even though the company has money, there starts to be more risk because the share price is already high, and management team, depending upon how aggressive management team is, they may want to take on too much risk to grow. And then too much risk to grow revenues, grow earnings, building larger and larger mines, so the management team can get their stock options and higher salaries and bonuses and things like that. That's where the average retail investor does not understand that. And that's what happened, I think, to Goldcorp. And that's what happened, I think, to New Gold. Yeah, I used to use stock options in the past. Again, not financial advice. You can use options for hedging. You can use options as insurance, too. I don't use options as much anymore. So that's where the valuation can change from potential high upside reward, where Lundin Mining brought that copper mine online, and the stock trade got a reward from the market with a higher copper price at a much higher multiple, much higher net asset value. And that's where the valuation can change from a upside reward, massive upside reward, into somewhat of a risk. And the average retail investor does not understand that at all either. John says invest in the asset, not the miner. I disagree. Oh, are you talking about physical gold and silver, or are you talking about the actual mine? If you're buying the mine, you also get management team with it. That's the dangerous part. So I think you're talking about physical gold and silver. Physical gold and silver is not necessarily an investment. It's just for insurance and wealth preservation. It's cheap insurance relative to buying like life insurance and stuff like that. But if you buy a company because of an asset of a specific mine, you could be getting a very bad, very stupid, very greedy, very high risk taking management team with it. So you have to understand, if you're buying an individual mining company, you have to understand management team, and you have to understand the assets then, and where the management team is going to use the capital on the assets, and if they can deliver. And you have to check then if management team has a track record of smartly using capital. And it can change quickly, unfortunately. A management team can go from being very good stewards of capital, getting good returns on invested capital, getting good returns on equity. It can change rapidly to negative in the mining industry. With other businesses, that may not. It's probably easier to maintain return on invested capital and return on equity than it is in the resource industry with oil companies and miners. So I've been speaking for almost 44 minutes straight. We're just about to go over 44 minutes. My voice is about to wear out. I want to go take a break. I think that's it for now. If there's any other questions in the comment section of the video after it's over, I can take a look. I'm going to go take a break for now. I'm pretty tired. Okay, bye everyone for now.